Today I will be discussing with you the vital concern of adjusting journal entries. So what are adjusting journal entries exactly? They are entries made in the general journal to record revenues that have been earned but not yet recorded, and expenses that have been incurred but not yet recorded. The matter of such entries arises as a result of the exchange of cash not always coinciding with the earning of a revenue or incurrence of an expense. The adjusting journal, and accounting as a whole, is concerned with two methods of documenting information: the cash basis of accounting, which records revenues when cash is received and expenses when they are unpaid, and secondly, the accrual basis of accounting, where revenues are recorded when they are earned and expenses when they are incurred. However, it is essential for all businesses to recognize that the generally accepted accounting principles require accounting information to be accrual-based. Failure to adhere to these standards can lead to regulatory action and penalties being issued. In case this isn't making much sense to you, let's go through some examples. Here, as you can see, the first entry only covers before the end of the period. Hence, an adjusting entry at the end of the period needs to be made to ensure the liability has been accounted for and the revenue they have earned has been increased. Okay, so because this is an accrued revenue, there doesn't need to be an entry before the end of the period, only at the end and after the end of the period. Hence, after the end of the period, the business should increase the cash account and decrease the accounts receivable account. Here, Johnny T Enterprises should immediately debit the insurance as a prepaid asset before the end of the period and credit the cash they paid. After the end of the period, they should then credit 1 month's worth of prepaid insurance, as it has lost that much of its value, whilst debiting the insurance expense that arises. Finally, at the end of the period, the company must always debit the expense and credit the payable, in this case salaries expense and salaries payable. However, once employees have been paid, the business must conduct a new entry that confirms such payment and therefore reduces both the liability and cash. Once the prior tasks have been completed, every business should focus on being able to close out the game as well as Kevin Durant does. The closing process consists of transferring all revenue, expenses and dividend accounts into the retained earnings account. Closing entries eliminate all temporary accounts from being unnecessarily added to the ledger, which allows for more precise and therefore accurate financial statements to be produced. Lastly, the accounting cycle plays its role in finalising the importance and use of adjusting journal entries. The accounting cycle refers to the ways in which an accounting information system captures, processes and reports transactions during a period. In summation, adjusting journal entries are vital to ensuring that companies are remaining in a healthy financial position and keeping up to date with the business's day-to-day transactions. Hope this has been helpful in clarifying the true reason for such actions to occur. Thank you.